Interesting and rather ominous day today. It's Tuesday. And today we saw a rather weird rotation out of all the hot sectors in Australia into all the defensive sectors. Interestingly, Goldman Sachs put out a list yesterday of the 12 best defensive stocks in the market, and they almost all went up today except for one of them. But today, people have been buying banks, boring defensive stocks like Woolworths, Wesfarmers, Coles, Telstra, Transurban, all the stocks that get left behind when the market rallies hard. So the risk-off stocks. So the Australian market seems to be getting a little bit cautious. And you may have seen last night, Michelle Bullock gave a warning. She said, people are thinking, well, could it all end up very badly? There's sort of no answers there, but people are just a little bit flummoxed about why credit spreads are really low, the risk premiums are really low, and what is it that makes the markets so comfortable? In other words, she thinks the market should be feeling uncomfortable. She's one of a now growing horde of sensible finger waggers telling us that the markets are in a bubble at the moment. And we have a huge test this week because we've got a few things coming up and the expectations are already very high. So it's almost a bit of a worry that things have to go really well for the market to stay where it is. So we've got the Trump-Xi Jinping meeting on Thursday, and it looks like Scott Bessent has already negotiated a framework which involves no rare earths export controls, no 100% tariffs, Chinese buying soybeans again. It's all a bit of a love-in, and it may well be a trade deal or it may be a trade truce, so they set a date for further out for when they have to sort other things out. But either way, expectations are high that that's going to go nicely, and there are going to be big handshakes and smiles, so the market factoring that in already. The other event is on Thursday, 5 a.m., the US Fed meeting will almost certainly cut rates. There's about a 98.6% chance of a rate cut. And another rate cut is expected, again, 98% in December. I think it's December 10, the next Fed meeting. So 2 Fed meetings coming up. So we should get a rate cut this week. And although that is entirely predictable, it is always quite a positive. So that should drive the markets. But as I say, the market's already expecting that as well. There might also be the announcement of the end of quantitative tightening, which is a process that's been going on ever since they printed a load of money. They've stopped issuing lots of bonds. So that might come to an end. That's a bit like an interest rate cut as well. So we had an inflation number last Friday, which was better than expected. So there's no reason the Fed isn't particularly or positively dovish, plus a rate cut on Thursday. So there's another positive coming along. We also have a US inflation number on Friday, and judging from the last one, that should be okay. But the main one is the big tech results. So we've got Apple, Amazon, Alphabet, Microsoft, Meta, all reporting results on Wednesday night, or Wednesday their time. So Thursday morning our time, we'll wake up to it, and on Friday morning as well. So they've got them Wednesday, Thursday. And that is the big driver of the market and the biggest risk, I think, because we all know there's huge capex. But the market's been running on big tech headlines. And just to point out, big tech, the 10 big tech stocks in the US are now 40% of the S&P 500. And the US markets are 50% of global equity markets. So 10 stocks account for 20% of global equity markets, and everyone's saying they're in a bubble. So these results have to be really good, really, really good to be okay. They have to be excellent to be good, but they have to be really, really good to be okay. And if they're only okay or not okay, it could be perilous. So we're going to wake up on Thursday morning to either glory or disaster when it comes to big tech results. So that's what we're all waiting for. As you probably know, the Marcus Today MT20 fund, which has $70 million in it of your money, that has cashed out. We have decided that everything we do is risk aware. It's not about what the returns are. We are and have got out of big tech because we think the risks are too high for this week. And we don't need to have everybody's money in the market for this moment. We're happy to avoid it. I'm not sure whether we're going to see a precipitous moment here, but the mere risk of it means that we prefer to step out. As I say, everything we do with risk is risk aware. It's become risky. It's not about the return. It's not about the trend. It's become risky. And everyone from Michelle Bullock to there are fund managers now who have pulled out of the market and writing bits of research about big tech. There are all sorts of doubts about big tech, how they're funding data centers, whether the earnings will ever turn up to justify the capex. There are all sorts of questions need to be answered. We've just ducked out ahead of this results season just in case. If those are good, the trade deal happens, the Fed cut rates and the inflation numbers okay this week, we're probably going to continue to go up. Everyone's going to be talking about Santa Claus rally, and I don't know what we will do there because we need themes that are not risky, and almost everything's up there at the moment. Well, let's see what happens on Thursday morning, Friday morning. It's going to be a very interesting week. Hi, I'm Marcus at Marcus Today. We've got two options for you. The first option is to do what everyone's been doing for 27 years at Marcus Today, the self-directed investors looking after their own investments using all the information, education in the newsletter, and sometimes copying our income or growth portfolio or strategy portfolio or Henry's small caps. We have another option now, which is the Marcus Today strategy portfolio, which is a real fund. It's been running since February. At this point, it's got over $60 million in it. It's growing very rapidly. We have a target 20, which is a rather ambitious target to get a 20% return per annum. And you now have the option to invest in that. So that should provide high transparency investment option, which suits pretty much everyone.